Hello, I'm Greg Hunter. Thank you for joining us today on USAWatchdog.com. Back with us again, Dr. Paul Craig Roberts. Among other things, he was Assistant Treasury Secretary in the Reagan administration. He was responsible for all economic policy for the United States of America. Just, Treasury Secretary, boom, he's on the next tier. That's among one of the many things he has done in his career. And so, Dr. Roberts, thank you for joining us today on USA Watchdog.
It's always a pleasure to be with you, Greg.
Well, you wrote on your website, paulcraigroberts.org, I believe it is, about the fiscal cliff. And I talked to you about this, and, I'm going to start with your summation of the article. And it says, America is going to crash big time. That's real common vernacular. We're headed for a crash. Explain.
All right, Greg. For about 20 years, beginning with the collapse of the Soviet Union and the rise of the high-speed internet, American corporations have moved the middle-class jobs offshore because they can get people in India and China and elsewhere to work for a small fraction of the American wage. So when you drop your labor costs like that, your profits go way up. So managerial bonuses go way up. The shareholders are happy because profits are up. Wall Street's happy. You're safe from, if you're the management of these corporations, you're safe from Wall Street organizing takeovers. And so it's comfortable for, the 1%. But for the rest of the people, it deprives them of a middle-class existence. It deprives the university graduates of jobs. For example, all the engineering jobs, software engineering, information technology, research, design, all those kinds of jobs that university graduates used to take are now done offshore. So the ladders of upward mobility in the United States have collapsed, and with it, the growth of consumer income. So consumer income has not only been stagnating, it's been falling, and also the net worth of the average American. So the consumer market collapses. And with it, the tax bases of cities and states. And so the deficit widens, not just for the federal government, but for all governments. And there's no way to close this deficit when the corporations are moving the tax base offshore.
So in order to get out of this long term,
that's when you take millions of jobs that were American, and with those jobs, their income, there's tax base, there's tax revenues, and you send that to some foreign country, that helps them tremendously. But it collapses the situation here. And so we now have this massive budget deficit and massive trade deficit because all the goods that are made offshore and sent back come in as imports. So that balloons the trade deficit. Well, anyhow, to get back to your question. So how do you close a budget deficit when you're making everybody in the country except the 1%, more dependent because you sent all the jobs offshore? So when you're faced with that, what do you do? Well, the Republicans say, oh, you cut the social safety net. You cut Social Security, Medicare, Medicaid, food stamps, unemployment compensation, housing services, everything that more and more people are now dependent on because the jobs are gone. And you've got people who used to be middle class, and then now they've lost their homes, they're struggling to survive. You've got kids who went to college and thinking they were going to get a job, and they've got out, and they've got huge student loans and no employment, and they're back home living with their parents. And so what do the Republicans want to do? Well, they want to drive those people deeper into the ground and take away whatever social support system remains. Now, and the Democrats, what do they want to do? The same thing, except they want to raise the taxes.
And keep a little of it and try to keep some of it. And,
yeah.
The dollar be damned. We don't care about that. We want to raise taxes, and we want to keep this going because it's power for our party.
That's it. But you see now, one of the taxes that they want to raise is the estate tax exemption. Right now it's like 5 million, which covers small businesses, farms. It covers the remains of the middle class. So the Democrats then want to jump in on top of the Republicans, on top of the middle class, and make it impossible for them to pass on the family farms, the family businesses to the children. So what you get out of the Republicans, what you get out of the Democrats, amounts to a double-barrel dose of austerity. But we know the economy is already weak.
You got rising taxes, crushing social programs, and you got a yin and yang that's ripping the country apart.
And consumer demand collapses, and the deficit rises. So the net effect of the Democratic and Republican approach to the fiscal crisis is to make it worse. The same thing happened in Greece. They hit Greece with austerity, trying to get public debt as a percent of the gross domestic product down. But what they knocked down was the gross domestic product. So the debt rose as a percent. And it looks like, with this right in front of our eyes, we're watching it, we're now going to repeat it.
You said in your one of your recent articles that the bank's subsidies, and I am sure you're including 0% interest rates, and you're including all these bailouts and TARP and all this stuff, dwarfs anything in the welfare system. Everybody thinks, and neither candidate in the election talked, they didn't talk anything about the $40 billion a month bailout we have going on, the 0% interest rates that the banks are making money, all these interest rate swaps and derivatives they have out there. None of that was talked about. They don't even mention it when they're negotiating the fiscal cliff. They don't. I mean, couldn't we save a lot of money if we stopped these banker bailouts?
Right. We could save the dollar, and we could avoid hyperinflation. We'll get to that. Yes, that's the TARP bailout, which was arranged by the Secretary of the Treasury, Paulson, the former chairman of Goldman Sachs. That was $750 billion. Now that is larger than the social welfare net.
It's a trouble asset relief program, which is really the trouble asset relief bait and switch program.
And that was on the backs of the taxpayers, because that was borrowed money that the taxpayers have to service indefinitely. It was given to the banks. Now, the next part of the bailout is the Federal Reserve. They are creating money with which to lend the banks or with which to buy up the banks' bad assets. And the last report, which was a couple of years ago, was that the Federal Reserve had created $16.3 trillion in new money. You know, a trillion is 1,000 billion.
Yeah.
So we're talking about 20-something times the size of the TARP bailout. Now, how does this come back to bite the taxpayer? Well, when the rest of the world is sitting around watching the Central Bank of the United States, the Federal Reserve, creating trillions of dollars in new money in order to buy up bad debt.
Mistakes, fraud,
that's right. And in order to finance the current operating deficit of the United States government, you see the rest of the world doesn't have $1 trillion+ in their trade surpluses to buy bonds. So we're now in a situation where the United States can't market its bonds. They're bought by the Federal Reserve, which simply creates money It's called monetizing debt.
Recent article on Bloomberg, just to underscore that for you. They spun this story in the media that, oh, the Fed's buying 90% of the Treasury debt out there, and the demand's going to tighten up. I mean, it's going to have Treasuries are going to be in short supply. That's why they spun that story. I mean, you have to be an absolute mental midget not to gaffe. And they're buying 90% of our debt.
That's right, and previously 120%. So, if you're the rest, suppose you're China, you're sitting there and you've got $2 trillion in U.S. dollar-denominated assets. You're Japan, you've got $1 trillion in U.S. Treasury bonds. You're the Saudi Arabians. You are the oil emirate investment funds, sovereign investment funds. You've got huge sums of money in dollars, and you're saying, look, what you're seeing is the Federal Reserve is monetizing at least $1 trillion a year, maybe several $1 trillion a year. What are these dollars worth? And so the point is going to come when they say we don't want these dollar-denominated assets. So it affects the bond market, it affects the stock market. Now, the Federal Reserve can create the money to buy up the stocks and bonds that foreigners dump. But when the foreigners get the dollars, they're going to dump them. And the Fed can't print foreign currencies. It can't print gold. And therefore, when the foreigners finish leaving the dollar by dumping the dollar's price collapses.
And everything gets more expensive. Gasoline, clothing, anything you import.
Collapses. We are a heavily import-dependent country, not just energy. Our import of manufactured goods dwarfs our imports of oil. Our imports of food are high. And so suddenly, and this can happen like overnight, Greg.
Wow. You said in your place an impending collapse of exchange value. That's what that's talking about.
That's right. And then all of a sudden, people walk in Walmart, as usual, in the morning, and they think they've walked into Neiman Marcus.
Oh, what a great visual. To walk into Walmart in the morning and think you walked into Neiman Marcus.
The question is the timing. I can't swear the timing. We've gotten away with this longer than I thought we would. And they can create conditions elsewhere in the world that keeps it going. For example, all the trouble about the euro, which largely we foment, it makes people say, oh, run to the dollar for safety.
That's spin, right? That's just a lie.
It's spin. It's all spin.
People are running to gold, are they not? I mean, I called a coin shop today in my home state, where my ma lives in St. Louis, Missouri, and everybody was all hands on deck. They had people lined up at the counters, yeah. And I'm just calling around to see, how things are going to get a feel for the account. I call this store, I call that coin store, all of them are busy. Yeah. Getting reports from people like Eric Sprott, who runs nearly a $10 billion fund. He thinks there's a shortage of gold, and he's not the only one. And apparently there is.
But let me tell you what they do there, Greg, and so your readers need to understand this. This happens in the gold market and the silver market. The demand for physical metal on the part of people who are worried about the dollar is high. And so this demand tends to drive up the price. For example, in the last 10 years, the price has gone from $250 an ounce to about $1,750. That's a many-fold increase. But the Federal Reserve committed to zero interest rates to save the banks. What it now does, when the gold price starts rising because of the demand of people for physical gold and also silver, they call up Goldman Sachs, JP Morgan, and they say, short the markets, because there's also a paper market in gold and silver. And the people who participate in the paper market, they don't want to take possession of the gold and silver. They just are playing on the price. And if they make a good contract, then they can make paper profits on the paper contract. And so when the demand for bullion causes the price to rise, the Fed goes in and sells naked shorts. A naked short means that the Fed doesn't have any gold and silver, but it sells it anyhow, and that drives down the price.
How long can they keep doing that is my question. When they stop delivering the gold at COMEX or the LBMA, the London Bullion Market Association, I believe it is, what happened? They can't deliver the gold to these big houses. Doesn't it all hit the fan?
No, because the Fed has been doing this for a year. Remember, I think it was in 2011, the gold price hit $1,900 and it was about to break loose. That's when they started. And so all of this year is mainly over, they've kept the price between roughly $1,700 and $1,750. And sometimes they drive it down in the 1600s. And they've driven the silver price, it was pushing 40, and they've driven it down into the low 30s, even the high 20s at some time. So they can do this because if they lose money on their contracts, they just print it. The Fed can create all the money it needs. The Fed can never go broke. The Federal Reserve can absorb endless hundreds of trillions, quadrillions of losses just by creating money. So they can, and they do the same thing in the stock market. When the stocks start to fall, they buy futures. They put in orders. It's called the plunge protection team.
That's right.
They put in orders to buy futures, and that drives the price up. So how long can they can manipulate this, Greg, until the rest of the world abandons the dollar?
And isn't that coming with all these agreements with Russia and China and India and Brazil and, South Africa and all these countries are saying, hey, yeah, we'll trade with you directly. We'll buy oil directly in yuan or ruble or whatever. I mean, that's happening now, right? I mean, these foreign countries all send people to Wharton Business School. They get it, right? They're not stupid.
Well, it saves them having to hold dollars that are being depreciated by the Fed, and it saves them the commissions of having to go out of one currency into the dollars and then and to pay off the other person, and the other person has to go out of dollars into its own currency and pay another commission. So it's much cheaper not to use the dollar. And that's what the BRICS, Brazil, India, Russia, China, South Africa, they formed up. Now, I don't know if they've worked out all the details between themselves such that it's actually in operation, but that's the intent. And also, this has not been reported to my knowledge in the American press, but the Asian countries are talking about having a common currency in which they trade among themselves without using the dollar.
So when the world bypasses the dollar, then isn't it all over?
It's all over. The power of the country collapses. We can't finance the wars or anything else. And whatever remains of net worth of Americans disappears. For example, any bonds you own become worthless because they're denominated in a currency whose price collapses. The price of the dollar is its exchange value into other currencies. Now, if we were all self-contained and we were not import dependent, and there weren't any foreign goods in Walmart and no foreign food in the stores, and we didn't have foreign energy, that it would be a different situation. But we are heavily foreign dependent, and therefore, when the price of the dollar goes, you're faced with hyperinflation. Basically, what you're faced with. Almost all, I think, in economic history, I believe is correct that all hyperinflations really began with a collapse in the exchange value of the currency.
Do you know
It wasn't just that the central bank was printing money. It was the foreigners view of the currency caused the exchange value to collapse. I think, for example, the Weimar inflation was because all the foreigners pull their money out of Germany. And if you do that all at once, you're selling a huge number of Deutschmarks. And if you dump all kinds of Deutschmarks on the market, the price is going to fall. And so when they dump the dollars on the market, the price of the dollar is going to fall. I'm surprised it hasn't already happened just as a protective mechanism against American aggression. You see, we're now surrounding China with military bases, new military bases. If they dump $2 trillion in the foreign exchange markets, it'd be the end of the United States. So I don't know, I don't know why they haven't done it. Maybe they're just waiting to see if we're able to go forward with this aggressive policy against them. So the real dilemma that we face is not the fiscal cliff. I mean, what Congress will do most likely is pass an extension. That's what they do with the budget resolutions. That's what they do with the debt limit ceiling. You always extend it. How are they going to reduce the deficit? They're going to cut the social safety net when all these unemployed people and people with no medical care and people losing their homes. I mean, you can't do that without creating political instability. How are they going to raise taxes and reduce consumer expenditures when the economy is weak? So all they can do is cut the wars, but the military security lobby is too powerful for them to cut the wars.
Cut the wars? What? Now, neither the Democrats or the Republicans have brought that up.
No one's ever mentioned the unfunded wars, right?
Dr. Roberts, you're needed in Washington. These people are in the dark. You're needed up there to tell them, hey, who's an idea? Let's stop all the wars. And the bank bailouts. That'd be another big savings.
The unfunded wars, the unfunded bank bailouts.
Not a word about that.
They just talk about funded programs like Social Security and Medicare, which are funded with the payroll tax. And they call those programs unfunded liabilities.
Unbelievable. I want to end by telling you this story. It's my bad.
Greg, they go on about 30 years of war. We're going to have 30 years of war. They're unfunded wars. They're expensive. They're more expensive than the welfare state. I mean, but, that can't be cut. I mean, good heavens, some Muslim with a box cutter might take over the country.
I will end with this, that a lot of people, I mean, in our world, we're attuned to what's going on. I had somebody stop me at a gas station and say, hey, I read your website all the time. And I said, oh, okay. I said, am I scaring you? And she says, well, yes, should I be? And I said, well, yeah. I mean, she admitted to me she was an accountant. And she said, yes, I know. You know what? You're right. I know you're right. But, a lot of people just won't take the effort to, and she says, this is just crazy that I have to protect my money out of the market, and the dollar's going to go away, and it's going to devalue, and, maybe I should buy gold and silver. I said, I don't tell you what to do. But a lot of people I talk to say buy gold, physical gold and silver. Is that as we summarize here, is that one way to, for Americans to avoid this big time crash you're talking about?
Well, the crash will happen, but that's one way to protect their wealth, at least historically. Historically, gold and silver have held their value whenever an inflation or hyperinflation occurs. That's why we see the gold price so high. Look, the official gold price used to be $35 an ounce, and then under Nixon, I think they raised it to $42 an ounce. But it's never been that low from the 80s on. And right now it's around $1,700 an ounce. So that shows you the degree to which the dollar has lost its value.
So people should wake up, because according to you, to summarize this, we'll end it. According to you, America is going to crash big time.
They're going to crash because they can't stop the hemorrhaging debt, and the way they cover that is to hemorrhage the dollar. So when you have debt pouring out and dollars pouring out, the dollar can't keep its value forever. At some point, people will run away from it, and it will start abroad.
Dr. Paul Craig Roberts, thank you so much for joining us today on USAWatchdog.com.
Pleased to be with you, Greg.